Gemlo is a company listed on a large stock market, and here you can see the statement of financial position, including the equity and non-current liabilities. And this company is now planning to expand of existing business operations, and which is cost $10 million in the near future, and is assessing its current financial position as part of the preparing a business case in support of seeking new finance. The key is that the business expansion can increase the PBIT, which is the profit before interest and tax, by 20% in the first year. The business expansion has already been announced to the stock market. Information on the expected increase in profits before interest and tax has not yet been announced, and the company has not decided on how the expansion is to be financed. In other words, the company has only released the information to the market on its expansion, but there's no financial information provided, including PBIT forecast, as well as the financing option. The ordinary shares of the company are trading at $3.75 per share on an ex-dividend basis, and the irredeemable loan notes have a cost of debt of 7%. So we got the market price per share. Also, we got the cost of debt for irredeemable loan notes, and for redeemable loan notes, or the loan notes, which is at 7%, the cost of that is 6%. And it is redeemed at 5% premium to the nominal value after 7 years. For the nominal value, it is $100 per loan note. And the question also provided that the interest cover ratio is 6 times. The company operates in the same business sector as Gemlo company, have an average debt to equity ratio at 40% on market value basis. And the average interest cover is 9 times. Gemlo agreed with the bank that its business expansion will be financed by the new issue of 8% loan notes. The company then announces to the stock market both its financing decision and the expected increase in profit before interest and tax arising from the business expansion. So with this information provided, you have to first calculate the debt to equity ratio of Gemlo company based on the market values. Here, we have 3 types of sources of finance. First is the equity. And it has debt, in which divided by irredeemable debt. And the loan note, which is for 7 years. For the equity part, we are given $3.75 per share, in which it is ex-dividend. And how many shares circulated or issued? Let's check. Because the ordinary shares at $1 nominal value is at 15 million. So the number of shares is 15 million. And with $3.75 per share at 15 million in issued, we can have the equity value in the market, equity value in terms of market value, which is $3.75 times 15 million, which is 56.25 million. And for debt, for irredeemable debt, The cost of debt is 7%, and it is 6% in redeemable debt. So for irredeemable debt, the valuation will be the book value is 10 million. 10 million with 6% interest divided by the before tax cost of debt, which is 7% or so here, which is 0.6 million divided by 7%, and then you got $8,571,000. For redeemable debt or the loan note, it has the coupon rate, which is 7%, and the book value is 12 million. So in other words, total interest incurred per year is 12 million times 7%, which is 0.84 million. And here, 12 million is the nominal value at the issued, and after 7 years, it is redeemed at 5% premium. In other words, it has to inflate by 5%. So we got here the calculation for this loan note valuation. We all know that the cost of debt is 6%, and we have the annuity factor at 7 years for 6%. And if you check the formula sheet, the annuity factor for 7 years at 6% is 5.582, with interest payment every year is 0.84 million. Then you got 4.689 million here. It is the interest for 7 year annuity, and you have to get the principal received after 7 years at discount factor for 6% as well. You have the annual discount factor, which is 0.665 times 12 million times inflated by 5%. So you got $8,379,000. So when you sum together of this number, you got about 13.068 million or 13.1 million for this loan note valuation. And we have the equity value. the irredeemable debt value, also the loan note value. So we can get the numbers here by summing up the debt, which is 13.086 plus the redeemable loan notes, which is 8.5 million divided by the equity value 56.25. So here 100%. Then you get 38.5%, which is B. Okay. So this question, you understand the logic is you have to get the market value for every type of source of finance here. And once you get the equity part, the irredeemable debts, you have to know, you should know how to get the valuation of the irredeemable debts based on the before tax cost of debt. Okay, remember, for valuation of the debt, no matter it is irredeemable or redeemable debt, you have to use the before tax cost of debt. Same for loan note at 7% with expiry in 7 years' time. You have to separate the valuation by annuity factor on the interest payment here, and also by the discounting of the nominal value at say 7 years later. So here is the part 1. For part 2, the question is asking if the stock market is semi-strong form efficient, what is the share price of Gemlo company right after the announcement? Okay. Remember the question, the information here showing that the planned investment has already announced. So in other words, the market has already known of this news. It's not a news, but the market participants or investors, they don't know the PBIT, the profit before interest and tax forecast, and the financing options. So right now, the company announced to the stock market on the financing decision here, and the expected increase in profits before interest and tax. So what's the share price performance under semi-strong form efficient assumption? First statement saying that no change in Gemlo company share prices as it has already reacted before the announcement. So if A is true, then the belief or the assumption is not semi-strong form. It is strong form because any insider information or any released information will be fully reflected in the share price performance. But it is not the case. So A should not be right. For B, no change, as current price reflects only information available in the past. In this case, if it is true, then the assumption on the efficient market, on the form of efficient market hypothesis is weak form, because only the weak form is saying that the share price reflects information only available in past. For C, share prices will quickly react to release of the new information. Under semi-strong form efficiency, the share price movement is immediately after the announcement, because the announcement may have the positive or negative news on its present value of the company's cash flow. So the market participants or investors will just buy or sell the shares right after the announcement. And it assumes that every investor will know how to get the value of the company by the news released. So C is correct because the key point is it is quickly react to the release of new information. And for D, it says that share prices will gradually move. Gradually means slowly move upon the release of new information to equilibrium. In the semi-strong form, it is not true because semi-strong form we focus on the perfect market assumptions that the participants can sell or buy the shares at the same price, and they will react immediately after the news release. So the answer should be C here.